That should be good to go. Good evening, good evening. How's everyone doing? If you could let me know whether you can hear me well and see my screen, that would be a fantastic beginning. Without that, I think we'll struggle. Let me make sure no pesky pop-ups come up. Goodbye, Discord. Fantastic. Hello to new faces and old faces. Nice to see people tuning in. Thank you for being here. I was obviously joking about holding the stream hostage for likes. But thank you to those who do that early on. It's much appreciated. It's not some internet clout obsession. It just genuinely helps the channel. And I like to believe that the channel has good information. So that's the reason for that. And I know Sharif is always promoting the likes on the videos. So thank you very much. So with it being 8 o'clock here and 7 UTC, let's go through our intro. I think if things go the way I think they will, this video will be slightly longer than the usual hour session. I've got a lot of notes to kind of go through and we'll have a good time. We'll have a good time, very instructional, educational. If you're watching this on as a kind of replay, for having seen the video on Twitter, make sure to like it and leave your feedback. I'd love to read it. So, first things first, thank you to Bybit for sponsoring Technical Roundup. Now, the newsletter, as well as the YouTube channel, their support has been fantastic, and most importantly, it's just given us the freedom to create scheduled, free, fully accessible content for you guys, essentially indefinitely. So that's pretty cool of them to do. Open up the description and just even click the link to visit Bybit. That'll help a lot. But generally, show them some love. It's also where I've been doing my Bitcoin trading. I've had no problems. Maybe another video on that another time, but a huge thank you to them. Second of all, go ahead, if I haven't traumatized you enough already, and like the video. Subscribe to the channel. It's not very often that I tweet out the live streams, but we are live every Monday, Wednesday, Friday, same time, same place, 7 UTC. So it'd be fantastic to have you as a subscriber, so you can click here yourself without me begging you to do so. And we're almost at 100 likes already. Donald in disbelief because he always forgets to ask, whereas I am shameless. Shameless, I tell you, and I beg. So here we are. I think that's it for the intros. Final thing would be that the newsletter, which is also free, comes out tomorrow at 8 UTC. So if for some reason you are starved of content within one day, link in the description. That is also free, as I've said. Go sign up, and that will come out tomorrow evening. Something for you to read before Donald's live stream. Richard says, the duck's apathy makes it hard for him to shill. It really does. It really does. Big up the duck. Of course, big up the duck. Big up the duck. Right, so let's have a chat. I don't think I'm going to do the whole kind of recap. You saw the 2-minute or 1.5 minute Twitter clip that I put out, and thank you to for all the engagement on that. I know you guys really like the short form stuff, so that was good. But a lot of the high time frame concepts we essentially revisited in that short clip. So I'm not going to go over it. As you know, I'll go over it quickly. The monthly time frame still looks positive. We broke resistance and we're now trading towards the next level at 14k. So that's reasonably straightforward. Now we've had the weekly close, so we'll give this a bit more time. Not by much, because really not much has changed. The weekly close was significant, having closed above this 11.5k area for me, right? And you get, again, this level comes from these highs and these lows, big level. We had a close above it, tested it as support, and we've had another consecutive close above the level now. So that's good. No evidence at the moment of a kind of failed breakout or some sort of, deviation pattern, etc. If that emerges, we can deal with it then. But based off the high time frame candle closes, that's not what the evidence seems to be suggesting. Now the weekly and monthly are quite aligned towards this 14k area or previous range, if you want to be nice and draw it as a box. So that's where the monthlies and the weeklies are pointing. Now that doesn't mean it goes up in a straight line. It may, God knows, but being prepared for levels of support to be retested is definitely one of the things that we'll be covering later in the stream. And if I didn't make that clear in my tweet, we're essentially going to have like a mini lesson presentation thing today once we cover the markets really quickly about basically getting over bear market PTSD, or rather adapting, or I suppose the politically correct or careful non-triggering definition of the video or title of the video would be, how would I say it? Adapting to trading in an uptrend or something like that. But I'm sure you'll get the point by bear market PTSD. So. That's the weekly close, fairly straightforward. Resistance reasonably far away, and the key level at 11.5 remains broken. And the daily time frame, this one's the exciting one. I mean, we've just had a breakout, right? There's no other way to, no further nuance to it. Price went sideways, and at the moment, it looks like we've broken out of that consolidation, and it will be quote-unquote confirmed when the daily candle closes in like 4 hours or whatever it is. But that's looking positive as well. You'll remember in the video, the Twitter clip, I was bullish at 11.8 and managed to snag a long around that level. And going over the reasoning there, this is something that I've talked on stream a million times, and I really hope it has your attention at this point, and it's something to pay attention to going forward, because it's just a pattern that works. When lightning doesn't strike twice, neither does a market double close twice. That was super clumsy, but you get the point, right? The whole argument was, if you're not familiar, we've had the close above, the level close below. That in itself is a bearish pattern, right? So if then the market comes back into the level, we expect resistance at the level itself. So failing that, that would signify a break in resistance, which is exactly what happened. You have resistance, you have the bearish pattern, price comes into the level, and then look at these two candlesticks, you get a close above the level. So for me, this price action here signified a reclaim or a break of resistance. The next day, tagged the level really nicely, and now we're here. If anyone caught that, I mean, fantastic. I'm not into the whole, oh my god, everyone like the video if you're on board type of bullshit. Trading is not a team sport. I don't trade for you, but if I can provide little insights along the way, what I'm seeing or what I think the level that help you, I mean, what more can one ask for, right? So that's where we are now. In terms of context, this is a pretty interesting one, because we're in a bit of a cluttered area, but one that I don't give too much technical weight to. And I want to make 2 points on that front. One is we know that the high time frame magnets, if you will, which is the monthly and weekly levels of resistance, are around the 14K handle. But that doesn't mean that intermediate resistance doesn't exist. And in this case, price made it very easy to identify where those levels are. And it's basically the swing highs in this consolidation. So you could do a very cursory bit of charting with something like this. This level has been broken. Then the next swing high, right, which is kind of where the market is now. And then the next swing high. I mean, you can even do this as a box, really. It doesn't really matter too much. Until the really important level at 14K. For me personally, I'm not going to be bearish by any means or even shifting to neutral until either 14K is reached, which I think is a massive level, and just generally in my trading, when price reaches a massive level of resistance on a high time frame, I'll shift from bullish to neutral or bearish to neutral if it's support. That would need to happen, or obviously some sort of, failed breakout or higher time frame bearishness, etc., etc. But really, because the higher time frames are pointing towards 14K, the point I'm trying to make here is I'm not totally ignoring, but at the same time, I'm not obsessed with these lower high levels, closer to mid 12s. Can they give a reaction and offer something, short-term discomfort and scalping, all of that type of stuff? Sure, but I still think the higher time frames, the real interesting areas are higher. Okay. Yeah, that's Bitcoin. What, anyone thinking about continuation trades or kind of pullbacks or anything like that? I don't love this area now that we've broken out of the range. I don't think the clear trades are going to be sort of around here. If you put a gun to my head, which I hope you don't, but there are two structures that I'd potentially be interested in. One is the kind of really obvious support resistance flip level at 12K. This is also very visible on the 4-hour time frame, but it's basically these prior highs that the market's now broken. So pullbacks into that level would technically be pullbacks into support. If you want to be really generous with it, you could just box out the entire consolidation before the breakout and say that, an impulsive move, sideways, impulsive move. So the whole pre-breakout range is now acting, or is presumed to act as support. I think that's reasonable if the market pulls back. I think what's slightly more realistic, if we keep trending up towards the higher time frame targets, and this is something we'll cover in my little mini presentation about trading a strong trend, but it's often not the level itself that was broken that offers a continuation, but rather the short consolidation that formed after a break of a key level that offers continuation. Okay, so let me just repeat that in case it doesn't make sense. If a market is moving very quickly and it's broken through a key level, yes, the ideal entry is at the retest of the level that was broken, but often you will have to settle for a higher entry at the consolidation which formed after the breakout. So in this case, as I mentioned, this is the level, this is the consolidation after the breakout. So you could literally box it out, this technical support at what, 12,150, and see what the market does here, being fully cognizant and comfortable with dips lower into 12k. I would start only to get uncomfortable if we basically lose the pre-breakout range, which is this level here. And why? Well, because we have 11.8 daily level, and that's the top of the range that we broke out of. If we, for some reason, fall below and fail, well, that would suggest the high time frame charts aren't ready yet, and the next high time frame magnets would then be to the downside, this 11.3, 11.4 level that we started with. Okay, that's some lower time frame context, and actually an example of this type of structure, where you have, a break of a key level, and you have to do business at the consolidation in order to retest, we can actually find in ETH USD, right? So if we go to ETH USD, that is pretty much a textbook perfect example of that, where you'll agree that 400 was, let me just get rid of this for a moment. 400 was the key level, it's the monthly level at 394, and all these weekly important stuff going on at 400. We can just draw it like this, okay? The level was broken by this candle here, and then put in this mini kind of range consolidation before the next leg up. Again, this featured in the mini video. And where did price find support when it pulled back? Yes, we'd all love, even for short-term trading, I'm not saying price will never pull back to the macro level. My personal view on these things is you kind of day trade or build a position, or even for a shorter-term trade at the higher level. And then if you get a high time frame dip towards the high time frame level, that's a kind of separate, that's where you build the swing trade, right? But this is a good example of just what I was talking about on the Bitcoin chart, where you have the high time frame, mega retest, textbook, technical analysis level at 400, but where the market finds support is actually at the cluster or the consolidation that formed after the level was broken, right? You get a mean little deviation, next candle engulfs it completely and then bounces off the level. So that's I'm not making this stuff up. In terms of ETH, given we've covered Bitcoin, in a very similar way, I see a lot of space above 400 until the next real high time frame level. If we treat this as a previous sort of range, I've already done it here, how helpful. Again, if you want to be pedantic about it, you could argue that, well, this could be the monthly wick, because, we're at monthly resistance, but we haven't closed above it because there's so much time left, 2 weeks left until the end of the month. That is true, but at the same time, if you only use the monthly time frame for your signals, it's likely to be a little bit slow or not always actionable if you're moving from a ranging to a trending environment. You could be semi-conservative and use the weekly time frame, or just jump one time frame lower. I'm a big fan of that, but I'm just going to work off the available evidence, and for me the available evidence suggests that 400 is currently not acting as resistance. Okay, so with all those disclaimers aside, as long as we stay above 400, or if you want to take a really high time frame view, even 360 is acceptable. This 400 area. All we're doing is trading back within this consolidation. So the next high time frame magnet for me is the mid-range. So basically the midpoint between the lowest close and the highest close, which lands at around 532. Okay, that's kind of where the monthlies are pointing. And on the weekly time frame, yeah, I'm comfortable making an argument, as before, that we are in an area of resistance, which is the pre-breakdown range. And by that I mean the market was ranging here, then you had a consolidation which led to a break of the range. So if you want to be conservative, around the 500 handle, actually that's a complete lie, that's not 500. Well, where is this price level if we use this lowest close? Around 450 is weekly resistance, but the real high time frame trouble areas for me are at higher prices. And on the daily time frame, yeah, I mean, we broke. This is what I mean by available evidence at monthly resistance. At the moment, this is, let's say, the 400 level. We can just eyeball it here. The market's well above it and broke it quite impulsively. So unless something like this happens and the level gets lost, ideally in a way which also breaks the lowest close. Basically, the range gets nuked, right? Something like this. Until something of a similar ilk occurs, I think high time frame directional bias being bullish is totally reasonable. Okay, and it's generally really nice, and I'm a big fan of these technical structures. When the market puts a leg up, consolidates at a high time frame level, and you're like, oh, is this distribution or is it consolidation? What the hell's going on? And then breaks out. That just makes the whole pre-breakout range a super useful technical structure, because you know that two levels matter, the top and the bottom. That's helpful, both for high time frame trading and for day trading the range itself. So that's nice. But more importantly, it gives you really clear directional bias that you're bullish into the pre-breakout range, but as soon as its arse falls out, then you can shift directional bias quite comfortably and capture like a high time frame swing in the opposite direction. So I think that largely applies to ETH on the time frame shown. For Bitcoin, the equivalent structure would be the weekly time frame pre-breakout range, especially one which shifted market structure. We absolutely love that sort of stuff, right? So that similar pre-breakout range or structure for Bitcoin would be this range here. You'll remember this range, or hopefully you don't. We live in better times now, but again, you had an impulsive move up, market moves sideways, and then the impulsive move up that follows, which shifted market structure, that gives this consolidation a lot of technical significance. Okay, so we know that if the market pulls back, yes, it would be rough falling back below mid 10k. You know, that's unfortunate. That'll be bearish, at least in the short term. But then we know we're back at in a range that's expected to act as support, with the range high and the range low, the levels being that matter. And also, in this, again, applying the same logic, if the range low then fails, we're kind of fucked. Okay, but that's just providing some further, providing some further technical context there, and we're far away from those levels at the moment. Final one would be ETH BTC. I'll keep this very short, but it played a useful part of my intraday long argument for Bitcoin. We have we're basically trading within the previous range here, range high, range low, forgive my drawings. And I essentially had ETH BTC at resistance, which made BTC USD the superior long, given the price action that I saw. This could be our range. I'm not sure. I mean, if the weekly close below it, so we could just see a bit of a pullback or consolidation. Doesn't mean it's going to nuke straight back to the level, but a slowdown wouldn't be unreasonable given the high time frame candle close. But the good thing is, if you're bullish ETH BTC, either to inform your ETH USD trading or just whether you trade ETH BTC, it's one of those instances where there's a lot of space between broken resistance and the next level of resistance. So in this case, I think it's like a 50% move or something between the break of this level and price reaching the next high time frame level. So you don't need to sit there, running circles in your mind over every single candle close at this level. Oh, I really want to catch this move, because there's like a 50% move to be caught, so you don't need to be surgical with your entries. Okay, I think that's the majors done. Bitcoin, Ethereum, and Ethereum BTC. Bitcoin, good weekly close and breakout from the daily range. I'd only start getting a bit sweaty in the short term if it falls back within 11.8. So something like this, right? If this breakout fails, i.e. something of this nature, that would be rough on a lower time frame basis, but I'll just look for the market to trade towards the weekly level at 11.4 and perhaps at its lowest the range low at 11k. And you can see this actually forms quite nicely as a range high, midpoint range low. If we break below the range low, then I mean this will look quite rough, but all it would mean is we then have to pay attention to the mid 10k area for reasons stated. That's the kind of short-term anatomy, but as we'll talk about in my little presentation, when the trend looks like it does, you have to be aware of these sorts of scenarios, but they shouldn't be your primary focus, okay? ETH USD, in a similar type of vein, we can even be slightly more generous and draw out this consolidation. How do I want to do this? Something like this, right? With the range, with the top line and the bottom line mattering, and saying that we've broken consolidation, dips into it, our dips into support. If its arse falls out, any breaks below 370, only then it gets rough, but presumption is for continuation until proven otherwise. That's the very straightforward summary, with ETH BTC being at high time frame resistance. Cool. I think that just about covers it. Donald, well, the newsletter will have a much deeper dive on the specific technicals for all of these markets. Link in the description, is free to sign up. Go do it right now while I'm babbling. And also Donald will be here tomorrow on Wednesday, obviously, to do his stuff. But yeah, the newsletter also does Litecoin and XRP and EOS and all this sort of stuff. So in the interests of time, and because I really want to do this bear market PTSD presentation, which is just about to start, we'll do the other majors later. I just wanted to give a quick recap of Bitcoin, ETH, and ETH BTC. Okay, now the actual interesting part. Thank you for bearing for those 20 minutes. Leave a like if you learned something. If not, well, I've done my job terribly and probably don't have much hope for what's coming next. However, it's time to get started with the talk, if you will, about bear market PTSD or trading in a strong trend. Okay, now this isn't going to be as structured, obviously, as my usual videos or articles or any of that kind of stuff. I've got on my other monitor just a sticky note of a couple of the bullet points I want to talk about. I haven't got pre-prepared examples or anything like that. If you smash the like button and leave enough comments and nice stuff, I'll definitely consider making a follow-up video in a full form to this. So if you enjoy the next 20-30 minutes, let me know, show some love, and then perhaps it'll be a good video topic. Unless the market nukes, in which case that will not be a good video topic and we'll all be very sad. Anyway, so getting over bear market PTSD, I think I'll just go over some bullet points and principles and we'll kind of build off of that. The first thing is, and some of these will sound very intuitive, but you'll see there's a bit more depth to it, is buy support. Okay? All the technical wisdom in the world that you'll hear says the trend is your friend and buy the dip and blah, blah, blah. And it gets lost in the, vacuous tweets and engagement bait of traders trying to sound clever. But it is true that if the market is trending up and you get a pullback to support, that generally is for buying. Okay? Crazy stuff, I know. Now, some important nuance and qualifiers to that is that you need to also adjust your expectations to what kind of, how you behave when the market reaches support. One important point that I still see people messing up a lot, and I've been guilty of this as well, of course, is that breakdowns at important support levels are more likely to be failed breakdowns than not. Okay? So what I mean by that is, say, ooh, hello, I didn't ask for you to come here. So let's say the market's trending up, right? And we've got some high time frame, whatever, Fugazi here. Thing is trending up, okay? And then the market pulls back to, let's say, an important level here. You actually get your high time frame retest, okay? Now, generally, if someone were to show you this diagram, you'd say, oh yeah, you buy the dip and, stop here or whatever. All of you would be comfortable with that. However, it's very likely that even on a high time frame, if not certainly intraday basis, that the market at least pokes and probes below the level of support, right? And which might make certain participants think the level's been broken. Oh my god, no, the trend is over. It's time to sell resistance. Head and shoulders, Peter Brandt redemption arc. We're going to zero, right? Now, an important thing to bear in mind is that when the market reaches important levels of support, be that intraday or high time frame, those breakdowns, quote unquote, are more likely to fail, i.e. get reclaimed later on, whatever it may be, than they are to actually break down and mark the, end in a trend. So everyone always says trade the trend, but you'll see those guys telling you to trade the trend when the market's up here, and those same guys go quiet when the market's down here. It's always the same shit. So when price reaches a high time frame level of support, one, don't assume it's going to roll over easily. Two, this is a bit more aggressive. I actually most of the time assume it's going to be reclaimed or some sort of deviation or bullish price action will unfold sooner or later. And perhaps the third point is that it's almost never worth in those instances shorting the breakdown, right? Because that is by definition kind of trading against the trend. I think the safer thing to do, or the more reasonable thing to do, is you either buy at a lower level, meaning that if the level is indeed broken and the market's going to pull back. I mean, a good example would be, let's say ETH at the 420 rectangle we drew, right? And we know there's high time frame support. Let's just do that, 420. And then we know we've got the 400 area as the high time frame level of support. So let's say even if the market does break 400 and it doesn't get reclaimed and, you know, starts to sell off, at that point you should be thinking, right, that's it, I'm going to short, the trend is over, etc. Why? Well, first of all, because you're betting against the trend, but second of all, a lot of the time you'll notice this only after the fact, but in a strong trend, there won't always be a lot of space left until the next level of high time frame support. So even if you catch this short here, let's say at 410, you're shorting for $10 in an uptrend into a level which could very violently reverse the whole thing. Okay? So to recap some of that, when you get prices at support, buy it. If support breaks down, be skeptical and keep an open mind to that level being reclaimed and forming a bullish setup after all. If the level does indeed break down, and certainly if that happens in the context where it's an intraday level breaking down and you've got a higher time frame level below it, it's rarely worth shorting the breakdown, but rather you should see that as an impetus to either buy at the lower level, right? Or, as mentioned, buy the reclaim at the higher level later on. Okay? Are you with me so far? Does that make sense? Okay, fantastic. Now, let me add another thing to my note, actually. Intraday Patterns. Sorry for the keyboard, I just had to add a note there. Okay, now let's talk about levels of resistance. Because we've talked about support, and we've got some more points on that, but let's talk about resistance. I get a fair, a heightened amount of question when in a strong trend about FTA, or like, what do? I just cut the trade at FTA and the market's doubled. I feel like such an idiot, etc., etc. So what do we do at resistance if the market is trending up strongly? Now, the good thing about this video is that if the trend reverses, you just do the opposite. Isn't that great? Now, again, this is all my personal view, blah, blah, blah. I'm not a financial advisor. Do whatever you want. However, my personal view is that resistances in a strong uptrend, there are a few points to bear in mind. And again, it's not that the levels disappear. This is something that I find really frustrating. And I think people, I don't know if it's lazy, if it's memeing, or maybe it's memeing, but some people take it seriously, which is the most fucked up scenario of all. But you'll see people say that resistance doesn't exist in an uptrend, which is complete bollocks, right? These levels don't vanish. It's just you have to adapt their purpose and give them some different expectations, right? Those, I think it comes with it's a nomenclature thing that you label something resistance, and therefore you're not going to use it. Whereas if you call it a level and the market breaks it, suddenly that's potentially a good long opportunity, which might not appeal to you psychologically if someone calls it resistance. You see what I'm saying? It's kind of like when people say, oh, supply, or this is demand. It's like, well, yeah, maybe. I mean, you've drawn a rectangle, good for you, but is it really helpful calling it supply demand? Because if it breaks, you know, are you going to be as comfortable buying the retest of that as opposed to then if you just called it a level and said, well, it's above the level support, I'm going to buy it. I think it's generally useful to try to be morally neutral in the language you use so that you don't get too biased. Like resistance doesn't exist, support doesn't exist. It's just levels, guys, and you can use them in both ways, especially if the market sets up. Now, what do we do with levels of resistance, or if you want to be careful, levels above market in a strong trend? I think there are a few points that are worth mentioning. The first would be that normally for me, profit taking will be taken at a full amount at a level of resistance. Okay, so as you know, resistance is typically FTA, first trouble area, and I normally will close the full position at FTA. That's still a good idea, it still works, it's not broken. However, especially in crypto and in strong trending markets, what you'll often see is the pullback that happens at resistance, especially when we get into some time frame stuff, which we'll do later. This context will make even more sense, but FTA will do its job a little bit, give a bit of a bounce, and then eventually be broken and the market trades way higher, and you feel like a bum for selling into essentially a higher low when you had a fantastic entry from lower, and then the market's right here, right? So how do we get around that? I think there are a few things. The first is that, quite simply, you take a partial profit at FTA. Now, depending on your position, sizing, your entry, etc., you can scale that to whatever you think appropriate. You might just want it to pay for the trade, so you take just over 1R if you account for fees, etc., at FTA, and then let the rest do what it may. It could be like 50%, or you can even take like 85% and keep a moon bag for the market to keep going. But basically, in a strong trend at levels of resistance, we essentially lower our expectations for how much damage is this level going to do, right? If let's say price is in a downtrend and it hits a really nice level of resistance, you're thinking, right, this thing is fucked. The market's about to nuke. It's over. Pack it up. And that's totally reasonable. But in a strong trend, we expect these levels of resistance to eventually be surpassed to overcome if the trend is going to continue. Therefore, in our minds, we should tailor our expectations to be lower and for these levels to do less damage. Okay? So when it comes to profit taking, whether you want to take 1 hour off at FTA, 1 hour, maybe you want to take half off, maybe you want to take, 85% off and keep a moon bag that you can compound later. Taking something off at resistance, but still keeping your position, especially if you have a really nice entry, is not the most unreasonable thing. I hope he doesn't mind me mentioning this. I used to talk to BitDealer when he was absolutely smashing like really low time frame scalps, and he started it when the market was chopping, right? So he would basically trade like a range on an M5, and he'd buy basically the range low. Midpoint would happen, and then he'd sell most of it at the range high, but because the market had started trending, it would just completely blast through his take profit every single time. So, he developed a strategy where he would hold on to a meaningful portion of the trade, even at resistance. And because of, obviously, the trend, the expectancy from those trades shot through the roof, because he was essentially not just going from range high to range low, he was going from range low to, market structure continuation. So that's an important thing. What else do we know about resistance, or can we say about resistance in a strong trend? I think another use for the level, as opposed to nuking the market or jumping out of positions completely, resistances are still useful, but for triggering a continuation entry if you don't have longs from lower, right? So in this instance, you could see the market come into a level and think, right, this is at resistance, but because of the trend, you almost reposition your mind to think, I don't want to sell this level, but if it breaks, I definitely want to buy this level. Now, that might seem counterintuitive because you're thinking of buying a level while the market's below it, but again, it's a continuation entry, so once it breaks, you're more prepared, you have a trading plan, and you get on board the break of resistance. So one, you hopefully position, make money on the move once the resistance is broken, but perhaps more importantly, at least from a capital preservation point of view, you're not scouting, you don't see this, market goes up, reacts, oh my god, so bearish, it's, market pulled back from this level, if it retests, I'm definitely selling it, mate. Well, that's not what we do in a strong trend, right? Instead, the way you think about the level is slightly different, and you plan continuation entry should that level of resistance be broken. That's also very helpful, okay? Another thing that is, I think, wise to consider is instead of taking full, take profit at resistance like you would in cases of FTA, instead, consider simply managing the trade at resistance instead of closing it as resistance, right? So again, this sort of goes back to the first point of, profit-taking partials, but it also could mean simply, trailing your stop up or moving, if you have way better entries, moving to the nearest level of market structure, whatever it may be. Again, we're changing how we look at resistance. It's not a tool to sell the market, but rather an area in which to manage the trade. Your presumption, you're still thinking in your mind that continuation at this level is more likely than reversal, but you are being somewhat risk cognizant by, at the very least, locking in some profit while trailing stop, whatever it may be, at the level, as opposed to thinking this is it, right? Another point at levels of resistance in a strong trend, compounding. If you have this good entry, right, let's say from much lower prices, and then the market eventually breaks that level, even if you've taken off a partial at the level itself, the break of the level is a fantastic opportunity usually to compound, especially when you're dealing with intraday structures in a strong high time frame trend. It's a really good chance that things move significantly and in your favor. So if there's nothing wrong with, that's the common concern, oh, why would I want to take off half my position if I expect resistance to break and then I'm only half as long? Well, then if the level breaks, if resistance breaks, you can compound or add or re-add or whatever, reallocate your size to make you comfortable with being in that position once again. So again, from a PTSD point of view, if you will, we're not looking at the market as an excuse to sell the level of resistance, but rather viewing it as a place to, take some partial profit, manage the trade, look for continuation entries, look for compounding of better entries. And these are all things that you obviously wouldn't do at resistance in a downtrend. But they may seem very self-apparent and obvious, but until you sit there and write them down and kind of shift your mind as to how you look at these levels, I think it's to your benefit. Okay, so we've talked about support. What have we said? We said that we buy support. Okay, that's an important one. We like to buy support in an uptrend. That's number one. Perhaps more importantly, number two, just summarizing here, high time frame, especially good levels of support which break down, they're more likely to be fake outs than not and failed breakdowns than not. Okay, which means that we like to get on board the reclaim of those moves, or at the very least, we don't like to short the breakdowns, certainly when there's a nice level of high time frame support slightly lower down, right? Don't try to chase the final leg, smaller leg down before a big move up in an uptrend, okay? This isn't worth it for the most part. As for resistance, you can take partial profit instead of fully closing an FTA. You can simply view a level not as a level to sell, but as a level to just trigger a trade continuation type of position as opposed to anything else. You can use resistances, especially if you've got good entries, to manage a trade and to compound a trade if you've, de-risked at the level for whatever else. I think the general theme is we buy support in an uptrend and we don't short its breakdown for the most part. And as for resistance, we manage the trade at resistance, but we don't look to sell it per se, but rather look for continuation trades above it in order to trade with the trend. Anyone with me so far? Okay, fantastic. Looks like we're keeping along. So that's pretty much support resistance. There's more stuff to talk about. Yeah, Felipe says, could you give a live example? ETHUSD is a pretty decent one, mate. On the 4 hour, again, hasn't gone absolutely batshit yet, but using this 420s cluster as an example, we had a close below it, right? Typically, let's say, whatever, in a different trend or different market, that would be bearish. But because of our expectations, the high time frame trend or whatever, in this case, price being above monthly resistance of 400s, the market looks good. It's just broken out of a big level. I don't trust this breakdown. So the trade in this instance isn't to do something like this, right? The trade idea is to get on board a reclaim, which is what materialized there. So again, from a replay mode point of view, it's essentially the context would be formed. Let me quickly do this. Would be formed here. The high time frame trend or whatever, the high time frame technicals are bullish, okay? But the market's just broken a level of support by closing below the cluster within the range. So again, if this were a different trend or a ranging market or a downtrend, whatever, it would be totally reasonable for your prevailing bias or your main bias to be something like this. Okay, I even covered this scenario as a kind of a potential one in the video. But if we have strict kind of trend conditions in mind, this idea, while technically valid, is far less probabilistic or has a lower probability of success than this type of setup. Because this is the trend continuation setup, and this is the I'm trying to catch a dip in an uptrend setup. Does that make sense as an example? I hope it does. Now, some other rules about bear market PTSD or some other things to bear in mind. I'm just going to go through these as they are. Now, what have I written here? I'm trying to understand my own notes. Consolidation breaks to the opposite. Oh, yeah. So, consolidations. Okay? Classic technical analysis will teach you that when you get an impulsive move, which then consolidates, normally that will break in the direction of the preceding move, right? So impulse, consolidation, impulse. Now, if you've traded Bitcoin in a range, you might be totally, well, completely not unreasonably skeptical of this claim, because the amount of times we've seen a big move up and then it barts down, right? Or distributes and spikes to range high and nukes. Like, we've all been sufficiently triggered by that sort of price action. However, when the market starts trending and generally number go up, and again, I'm not making crazy assertions as to Bitcoin and Ethereum, whatever. I just, a lot of alts are trending up even more convincingly than the majors. So this is just stuff to bear in mind. Okay, I'm not crazy fanatical about the markets in either way. Just providing some context. So We've all seen those types of really dodgy patterns. We BART down, or we spike the top and then BART down as well, all this sort of stuff. But generally, once the market enters a strong trend, especially on the high time frame, and we know where the high time frame things, high time frames are pointing up, consolidations that follow an impulsive move do, in those conditions, tend to resolve in the direction of the preceding move, okay? So this model, right, where it goes up, sideways, and then it's more likely to go up than it is down, it's not about the pattern being good or bad. As with most TA things, it's about the context, right? So if the context is appropriate, you've seen, Loma, Gainsey, all these guys tweet similar stuff because it's right, that it's, buy the triangle season. That's essentially what it comes down to. If the high time frames are pointing up, price moving sideways and consolidation patterns are more likely to break up than not. So don't put on your tinfoil hat on every single bit of sideways and think, oh no, the BART's coming. I've got a Pavlovian condition to sell any sideways because the amount of times I got liquidated on a BART pattern is terrifying. That's not, I think, what should be the prevailing presumption when the trend is strong. It should be the opposite, that these consolidations or these sideways movements are more likely to break up than not, and the whole BART type of price action was, consigned to a reasonably unique point in the market, or at least it's much more reasonable to expect the fake out, BART stuff, whatever, in a range or in a downtrend rather than in an uptrend. Perhaps an alternative way of phrasing it, there is no worse time in terms of probabilities to position for a breakdown of every single sideways movement than in an uptrend. Okay, it's literally, you can't think of a worse time. And even if you catch it once, you'll miss it 5 times and it breaks up. So it's really not worth it. Don't bet against yourself. Don't make things harder than they should be. Okay. And obviously the logical consequence of that, to some extent, and this is where things get potentially a bit murky, but consolidations are for buying, right? Because what you'll see a lot of the time is, market will impulse up, it'll consolidate, and then the technical analyst dude will be like, well, the consolidation breaks out, you buy a retest, and, you put your stop at the low, and then the market goes up. I mean, how many times has this actually played out in that type of fashion? More often than not, it'll consolidate, and then the candle will be like triple the range within this consolidation, then you kind of have to buy the top. So in the interests of actually getting positioned and doing real trading instead of TA trading, a lot of the time you take a not unreasonable bet while price is consolidating, right? So within here, that the consolidation is going to break to the upside. And if it doesn't, that's fine. You're not always going to get a perfect continuation entry, and especially if there's a high time frame level of support close to market, I'll normally avoid trading within the consolidation. But generally, if we've just broken a key level and there's a lot of hot air in the market until the next high time frame level, these consolidations, buying within them is totally reasonable in my view. Okay. Now another thing, next point. So what we've covered so far, we've talked about levels of support, how to treat them, how to look at them. We've talked about levels of resistance, how to treat them, how to look at them. We've talked about consolidations, and now I guess we're going to talk about some general tips. So the first one would be that you should get comfortable doing businesses, lol. You should get comfortable doing business at extremes. What do I mean by extremes? I mean, if you're someone who's used to a very kind of clean, slow-moving, rounded retest of a level, and then, this sort of stuff, it's not always going to happen, certainly not on higher time frames. By extremes, a very basic example, one that I'm using at the moment, would be wicks instead of bodies, right? Wicks instead of bodies, that's a really good example. At the extreme of a range would also be another one. So, for example, deviations or moves deep into support, which may look uncomfortable and may look bearish but aren't. That's also something to mentally prepare for. And just generally being, and also, here we go, consolidations, console above key level, right? Where you might think, and again, the technical analyst will be like, well, okay, this level's... How many times have you seen this shit? Like, a market completely smashes a level, and then the TA guy will be like, oh, this is so bullish. I really want to get long. I'm dying to get long. I just need a retest, and I'll get long. So full of shit. If you're dying to get long, and this is really as important as you're making it out to be, then get fucking long, and if it dips, you can figure that shit out later, right? I've never understood that. It's been the most nonsensical thing ever. Like, oh my god, the best level on the chart has been broken. This thing is so bullish, but for some reason, I now need the market to shit 5% to get long. What a bunch of horse shit. It just doesn't make any sense logically either, right? So those are some examples of doing business at the extremes, and I suppose getting comfortable with invalidation at lower levels, right? What else do I have in my notes here? Yeah, also, business at extremes also applies with regard to speed, right? And this also has some bearing on the rounded retest point. Now, it's not the case that the market will never come back and retest levels, but if the market is trending strongly, then you need to be ready for those retests to be less obvious, for price to spend less time retesting those levels, and for those retests to occur on lower timeframes again. So while you might be comfortable with the idea of, oh, the market's broken out, blah, 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 comes back, gives me a perfect entry, you know, this sort of thing, a lot of the time what you'll be faced with, even at similar levels, is the market will come up, close above the level, kind of just barely, ping it, literally same candle which closes above it, or the next one, puts in the wick, on like the M15 or the hourly, and then the market goes bloody apeshit, right? So you'll have people thinking, okay, well, you know, break above and waiting for the retest, and then you jump down a couple time frames and realize that the retest has already taken place. Okay, so when I talk about doing business at the extremes, yes, it does mean in terms of structure with regard to kind of levels and ranges, consolidations, wicks, etc. But it also means the scale is essentially turned up a few notches. Whereas in the past, or certainly within a range, you can afford the luxury of a nice rounded retest and PA developing, deviation, bullish, blah, 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 all that kind of stuff. A lot of the time for fast-moving markets, especially early in a trend, or when there's a lot of empty space between high time frame levels, when you're using these levels, when you're using any type of level as a reference point, get comfortable with shorter time frame retests. Okay, that's just the rule of the game. And yeah, the other note I've got here, which I've covered earlier, is pullbacks into post-breakout consolidation as opposed to the level itself, which is what we talked about or looked at for ETH. But it would essentially be level gets broken, market consolidates a bit, and then breaks out again, right? Let's say something like this. I mean, this isn't the best drawing. Let me try that again. Yeah, something like this. Okay, so you have the break of the level, and then the market consolidated after breaking the level, right? So level, broken, market consolidates, breaks away again, and then it starts to pull back. At times, you need to be comfortable with doing business at the consolidation as opposed to at the level itself. Or at the very least, and this is another tip we'll cover, you start building your position at the consolidation, cognizant of the fact that it may not reach all the way back and retest the level. And then, you know, let's say you get half size on at the consolidation, then if it dips the level, great, you're full size. If not, and it does, you know, forms an aggressive continuation, then you have something on the table. Okay, that's pretty helpful. Or something to be aware of. And that brings me to kind of the next general tip. In terms of positioning, you can always position smaller size for continuation away from the best levels and see if a swing develops from that. Okay? And then if you're stopped, you have dry powder into the high time frame level. Right? So it's basically literally the model I just showed, where you have the break of the key level, and then you have some sort of important or useful technical structure formed here, away from the level itself, right? I'm going to make the level in blue, so it's obvious what I'm talking about, because I guess these are all levels. So this is the key high time frame level, and then you've got a level above it. In terms of the sizing, right, or if you want to feel out a position or just get something rolling, you go half size at the consolidation or at the aggressive continuation level, and then if it's nice enough to give you a pullback to the high time frame, that's where you can either build your swing or load up the rest. Okay, I suppose the safe entry would be to wait for the high time frame level to be tested and then enter on some sort of confirmation through this, but these leave me wanting a lot of the time, and they're much easier to draw than they are to actually trade. Okay, in a strong trend, you're almost looking for reasons to get long. Okay, the people who suffer most in strong trends are the ones who are always waiting for the crazy high time frame pullback, right? And, they might look at levels of resistance, and even, let's say best case, like what some idiots do is they'll look at, a key level will be broken, right? You'll have a break of a really nice level, and the market will be above it. And then you'll have like shitty levels of resistance here, etc. And those same guys, in an act of astonishing cognitive dissonance, what they'll say is, well, look, the high time frame level needs to be retested, so I'm going to sell the market down to that level and then trade it long at the level itself. Absolutely bonkers, right? Makes no sense whatsoever. And then what those guys end up doing is they sell the level, eat shit, sell the level, eat shit, sell the level, eat shit. And then when the market finally comes back to the high time frame level, usually just don't have the balls to trade it and, make a dog's dinner out of that as well and lose money. Okay? Let's say even the better outcome, where you get the break of the high time frame level, like the slightly improved version of that, and the market comes into resistance, and that guy's like, well, I'm not selling it, but I'll buy the retest of support. So while he's like, I'm not buying, I'm not buying, I'm not buying, I'm not buying, and then the market finally pulls back, he's like, haha, I told you so, easy, right? The guys trading the trend have made like 10R or like 5 profitable trades, while this guy's waited for one opportunity, which is going to be much harder to trade because the market looks very scary at that point, etc., etc. Who knows what the technicals look like? But you don't earn anything by waiting for... I suppose the opportunity cost of waiting for a perfect pullback is usually too damn high. You're better off trading the continuation until it stops working and then join this guy's team, rather than see a high time frame level be broken and think, well, I guess I've got nothing to do until it retests. It makes absolutely no sense. Doesn't make any sense at all. I've got a couple notes on taking profit. Well, I've said trailing stops versus FTA. This is something we talked about towards the beginning, where it's essentially, if you don't want to close the trade, especially if you've got something with a good entry, just trail your stop as market structure develops or as the trade moves in your favor. Whether it's resistance being broken or whatever else, simply moving your stop is to lock in gains rather than trying to essentially catch the top by selling resistance every time. That could be a viable strategy, especially if you are cursed with weak hands. I still think taking profit at FTA is a reasonable strategy, but only as long as you're like a descendant of trader 1SZ and you know how to get back in no matter what happens, right? No matter what happens. Let's say, you get back, you sell at resistance, market pulls back slightly, and then it breaks it completely. It's fine not to do the whole trailing stop thing if you have a very clear plan to get back into the market. And even if that plan takes you to do business at maybe uncomfortable levels as opposed to the perfect level. I suppose that's a recurring theme throughout this whole mini presentation, is a lot of the time in a strong trend, you need to get comfortable being uncomfortable and doing stuff until it stops working, even if it's not optimal, okay? Ooh, here's another thing about take profits and kind of high risk reward trades. A really good way of structuring your, entry, stop loss, target type of thing in a strong trend. And if you really want to get those crazy skewed ratios, pretty simple. You hold your intraday entries into high time frame targets. Okay, so you hold intraday entries into high time frame targets. So if we go back to the FTA video, which I hope you've all watched on my channel, normally, under normal conditions, FTA is determined on the same time frame under which the trade was entered, right? So if you've got a weekly trade, your FTA for take profit, for those of you who watched the video, your FTA for take profit is on the same time frame, on the weekly time frame, daily to daily, etc., intraday to intraday. Okay, now when we have a strong trend and the market's moving aggressively, and again, especially when the context is such that there's a lot of space between high time frame levels and we expect that space to be filled reasonably quickly, what we do to skew risk reward in our favor and also stop ourselves from cutting trades really early is to hold intraday entries to high time frame targets. So to show an example, if you get an hourly continuation entry, you hold that until, let's say, a daily level of resistance. Right? Or let's say a 4-hour entry, you hold that until like a daily or a weekly level of resistance. And that way, again, an uptrend depends or assumes that levels of resistance are going to be broken sooner rather than later or eventually, whatever, if the trend is going to persist. So if that is our working assumption that levels of resistance are there to be broken or will be surpassed eventually, does it make sense in a high time frame trend at the very least to buy support to only sell resistance on the same time frame? Obviously not, because that contradicts our working assumption for the trend. So the way we essentially compensate for that is by shooting for the stars and tailoring our expectations to the trend. So intraday entries become then valid for holding towards higher time frame targets, because our working assumption for the trend is we're going to move towards higher time frame targets. So your entry should be a kind of gift sort of thing. Okay, the final note I've got is about intraday patterns and just being aware of failure rates. Certainly if you're watching lower time frames on around higher time frame levels. And this is kind of again, being cognizant of the trend sort of thing. Bullish patterns in an uptrend are going to play out very often and be successful. Bearish patterns in an uptrend are going to fail much more often. And even if they look like they're going to be successful, it's probably a trap and not going to work anywhere near as well. So an example would be, let's say prices, whatever, we're in a strong trend around a high time frame level of support, and you get a really kind of scary looking, I don't even know how to draw this thing, man. How to draw it convincingly. Let's say this kind of wonky, uptrendy head and shoulders type of thing, right? And then you even get the kind of break of the dodgy trend loom neckline, okay? What you'll often see is the failure rate on bearish patterns in an uptrend is crazy high. So a lot of the time, this will actually be fuel for a trap. So, it'll reclaim the trend line and then actually turns into a nice long, okay? Same thing for, let's say, rising wedges. It looks really scary. Then the market dumps out of the bottom of the wedge. Okay, what you'll often see if this trend is strong and an uptrend is, so this is pattern failure, right? I suppose that's what I should call this section. Pattern failure. Be aware of pattern failure. In a strong trend, bullish patterns will just generally work out, right? Triangles go up, but bearish patterns will fake out and give you kind of bait, which is more likely to fail than not. So head and shoulders, the breakdown will just get bought back up. The rising wedge breakdown in a similar type of way. A lot of people will end up on the wrong side of that, and then market's likely to reverse. Same with trend line breaks, just generally, right? Very likely to end up as deviations of some sort and making sellers of those structures uncomfortable. There are a million other patterns. I'm sure. I mean, even just basic triangles, right? Basic consolidations. You'll see it spike one side, start to look really bearish, and then just do something like that. So be prepared. Context, high time frame context always informs pattern failure. If the market's going up a lot, expect the bearish patterns to either eat shit completely or not play out to the full extent that they should, and expect bullish patterns to work, and vice versa if the trend is reversed, obviously. Okay? So to recap some of the stuff we've talked about, I think that's all for my notes. Support is for buying. Breaks of support, we like to wait for the reclaim or do business at a nicer, higher time frame level below market. It's almost always not worth chasing the breakdown of support in an uptrend. Okay, certainly if you're a beginner. As for resistance, a lot of that is basically flipped. It's still useful. It's not like resistance vanishes off the chart. We just use it. We have different use cases for those levels above market if we are in a strong bullish trend. So we can take partial profits at resistance. We can use those levels to plan and trigger continuation trades when they're broken. We can use them for managing trades of existing longs and or for compounding for those existing positions as well. And in a similar way, just like breakdowns of support aren't for selling, the levels of resistance aren't really for selling either. Okay, at least that's not our guiding bias coming into those levels. Because again, if we are in an uptrend, you expect that level to be broken eventually. So why are you trying to sell it rather than looking for ways to make money when or if it breaks eventually? So that's the SR section. As for consolidations, generally they'll break to the upside or break in the direction of the strong trend. Okay, and consolidations are for buying a lot of the time. You make a calculated bet that this will resolve in the direction of the trend. Yes, it might fake out, it might spike down, and sometimes it might even fail. But again, the whole point of trading a trend is you do stuff that works until it stops working. And a lot of the time, the market simply just won't give you the type of break, retest from consolidation, be it a triangle one or a range one, etc., that you'd like. So you have to get comfortable being uncomfortable and either trading within the consolidation or above it without the kind of clean retest that everyone and their grandmother wants. That's something, the price we pay for number go up. Okay? More generally, we want to get comfortable doing, you know what, let me just bring this over. Hello, love. Where are you? Here we go. More generally, we like to get comfortable doing business at extremes, right? And examples of extremes, we're kind of using wicks and the extremes of ranges, you know, deviations, all this sort of stuff. But it also means extremes when it comes to scale, which means while we'd love to get a high time frame, super rounded, complete retest of every single level, a lot of the time in a fast moving market, it's not feasible. And we have to lower our time frames and look for wicks and be ready for the market to progress from level to level in a much faster fashion than we may be comfortable with. Okay? And we had some examples of that, of doing business above the level, but also pullbacks into post-breakout consolidations as opposed to the breakout level. Again, just what that looks like. You have a break above the level, consolidation, another leg up. This is the key level. This is the consolidation. And the first order of business is at the top of the consolidation. Okay? And then we covered some ways to mess around with position sizing, where we can get smaller size for the continuation trade, for the aggressive one, and then you keep some dry powder should the market come into the high time frame level. But again, the market pulls back to support, we buy support. If it pulls back to higher time frame support, great, because at that point we still want to do business there because invalidation is nearby, and that's great for a trend, and where a lot of the very positively skewed risk reward stuff comes in. Some general take profit stuff. Trailing stops versus FTA, we've had some discussions on that. It really depends on your preference. I generally think that in strong trending markets, trailing stops type of systems, unless you're, again, descendant of trader SZ who knows how to get back in a trade no matter what happens, generally outperform. But if you can get back in no matter what, fantastic. And a strategy, as mentioned about the risk reward stuff, is that we take, even if you're using the FTA method, we essentially adjust it and we are comfortable holding intraday positions into high time frame FTA, which we wouldn't typically do if the market's moving sideways or not fast moving generally. Okay, and the final note about intraday patterns, it's about setting your expectations with failure and or success rates. If the market's trending up strongly, we generally expect the basic consolidation, continuation stuff, be it sideways, triangles, whatever, to work and to break upwards. As for bearish patterns, we certainly don't chase them, but if anything, just like what we're doing with breakdowns of support, okay, or failed breakdowns, we do the same with patterns. A really scary looking head and shoulders in an area of support, you're looking for that to act as an impetus or an area where people get on the wrong side of a trend, and then we apply pressure when they are inevitably squeezed. Okay, be that a rising wedge, kind of attempted breakdown, or the triangle hitting south before hitting north, or whatever it may be, even just deviations from a range. The intraday patterns provide important context. We always want to know which side of them we want to be on. Okay, the bullish stuff will work, the bearish stuff will either work badly or not work at all, and bearish patterns not working is actually a bullish trade opportunity in itself, as discussed here. That's all I've got. Has anyone learnt anything at all? Fantastic. If we can smash 250 likes, let's do it. I know we've got it in us. Hit the like button, even if you learnt one thing or one thing was made clearer. Shows me that I'm doing a decent job in some instances, so that will be very helpful, and I appreciate that very much. It looks like I should make a longer / more formal video on this. I'll consider it if I've got time between all the stuff I'm doing. As you've seen, I've been punting off trade ideas and trades on Twitter and other places as well, so I've been kind of busy myself. These moments don't come all too often where my levels and just my system really excels and makes my life comfortable. So my priority is making the most of that, but I think should some time come around, this would be a good topic for a video. But for now, that's all I've got. Thank you so much for watching. Thank you to Bybit for sponsoring Technical Roundup. Again, guys, I appreciate the likes and helping me out, but just go click the link in the description. Just even clicking it makes a difference. That'll be really cool, and show them some love. They're the reason I can do this sort of thing. If you are starved for content, also in the description is a link to Technical Roundup, the weekly newsletter. That comes out tomorrow at 8 p.m. UTC. So basically right now in like, whatever, 24 hours? No, 23, yeah, 24 hours. So go subscribe to that and you'll have myself and the Duck talking shop about some of the majors that we didn't have a chance to cover in today's session, just to not make it crazy long. And then you'll have Duck on Wednesday, and I might be in the chat talking some smack. Thank you very much for watching. If you're from Twitter or from the future, make sure to like this video, subscribe to the channel. That's very important because I'm not always going to give notifications on Twitter and Telegram. In fact, I generally don't. So if you haven't subscribed, you'll miss more good stuff. But for now, I thank you for your attention. Good luck in this market. It'd be hilarious if this was the actual giga top forever and I just made this bull market video before like 100% drop. But I guess it's still a useful video because then we just do the opposite. Alright guys, I'm going to stop babbling. Take care and I'll see you for the next one.